Hello, I'm Shazwan. Today, we will be presenting a trend and cross-sectional analysis on two companies in the healthcare industry, which is IHH Healthcare Berhad and KPJ Healthcare Berhad. I am the first speaker of our presentation today and will be followed by Aizad, Izuddin, Azrul, Hanif, and lastly Najiha. Our presentation today will cover four key ratios, which is liquidity, activity, leverage, profitability of each company from 2020 to 2024. Now we will start our presentation with a background on IHH Healthcare Berhad. IHH Healthcare Berhad, headquartered in Kuala Lumpur, Malaysia. It is one of the world's top three global healthcare providers by market value, which is around 50 billion as of 2024. IHH is established in 2010 through a merger of Parkway Holdings and Pantai Holdings, which now employs over 65,000 staff globally. The group has pursued aggressive expansion through acquisition, particularly in India and Southeast Asia, and are now operating in more than 10 countries. Now we move to our first ratio, which is current ratio. The current ratio for IHH Healthcare Berhad has peaked at 1.41 in 2021, which indicates a comfortable liquidity. This then declines from 1.31 in 2020 to 0.90 in 2023 and fell further to 0.72 in 2024. From the graph, we can conclude that IHH is facing a significant liquidity risk. This suggests a potential difficulty in meeting obligations without selling long-term assets, raising capitals, or renegotiating debts. Next, we move to quick ratio. For quick ratio, the graph shows that IHH had peaked at 1.26 in 2021, which shows a strong immediate liquidity. However, it fell to 0.61 in 2022 and it fell further to 0.57 in 2024. What this shows is it shows that IHH is facing a severe liquidity crisis. The decline point to a reduced immediate assets or increase in liabilities, suggesting that the company is struggling to cover obligations without relying on inventory sales. Next, we move to inventory turnover. For inventory turnover, IHH has improved from 8.67 in 2020 to a peak of 9.89 in 2021. This shows a highly efficient inventory management by IHH. This then gradually declined to 9.21 in 2024. Overall, the figures show a strong inventory efficiency, although a slight decrease after 2021 may reflect a slower in demand, overstocking, or adjustment in procurement strategy. Last, we move to receivable turnover. What we can see from the graph is we can see that receivable turnover rose from 7.68 in 2020 to a high of 9.30 in 2021, which then stabilized around 8.83 in 2024. This trend indicates that IHH Healthcare is effectively managing its credit policy and it is collecting payments faster over time. This is a positive sign for cash flow, partially offsetting the liquidity concerns from the current and quick ratio. That is all from me. Thank you.
Hello, my name is Muhammad Zabir Ibrahim, and now I will be presenting the financial performance of IHS Healthcare Berhad through an analysis of its leverage and profitability ratios from 2020 to 2024. Let's start with the leverage ratio, which reflect the company's financial risk and ability to meet its obligations. This measures the company's ability to pay interest on its debt. In 2020, its interest coverage ratio was 2.22, which indicates limited ability to cover interest. In 2021, it jumped significantly to 6.75, reflecting improved earnings or reduced interest expenses. The ratio remained strong from 2022 to 2024, with 5.7 in 2022, peaking at 6.88 in 2023, and slightly dropping to 5.77 in 2024. Overall, the trend shows enhanced capacity to cover interest, suggesting stronger financial health over time. This indicates how much debt the company use to finance its assets compared to shareholders' equity. Starting at 0.43 in 2020, the ratio steadily declined to a low of 0.28 in 2023. It's likely to 0.36 in 2024, but still indicates a conservative capital structure. The downward trend shows reduced financial risk and stronger reliance on equity rather than debt. Now we're moving on the profitability ratios, which indicates how well the company is generating income. This shows how efficiently the company use its asset to generate profit. In 2020, ROA, which return on asset, was just 0.44%, likely due to pandemic disruptions maybe. It rose sharply to 3.94% in 2021 and continued to increase to 5.98% in 2023. In 2024, it slightly declined to 4.97%, but still reflects strong asset utilization. This ratio reveals how much profit is made after deducting the cost of goods sold, starting at 69.43% in 2020. The margin remained strong and stable over the years. It reached 72.03% in 2024, indicating improved cost control and pricing efficiency. This consistently high margin is a positive sign of the company's pricing power and operational efficiency. So, in a conclusion, IHH Healthcare Berhad has shown a strong improvement in interest coverage and declining debt to equity ratio, which indicates better financial stability. Increasing ROA and consistently high gross profits margins reflecting strong profitability and efficiencies. These trends point to a financial healthier and more efficient company over the past 5 years. Thank you.
Assalamualaikum. I'm Muhammad Izzuddin bin Muhammad Hairuddin. I will share KPJ Healthcare Berhad background. KPJ Healthcare Berhad, a prominent private healthcare provider in Malaysia, operates under the Johor Corporation, known as JCOP. It's a state-owned investment entity of Johor, now Malaysia's largest private healthcare group. Established in 1981 with its inaugural facility, provider with extensive hospital coverage, strong international reach, state-of-the-art specialization, and a significant commitment to community care, education, and also innovation. KPJ Healthcare Berhad with a mission, deliver healthcare services, and with a vision, the preferred healthcare partner, was listed on Bursa Malaysia since 1994. KPJ expansion spans 28 specialist hospitals across Malaysia, Indonesia, Thailand, Bangladesh, and also Australia, offering advanced medical service such as cardiac care, oncology, orthopedic for women, and also pediatric health. All right, next I will cover for trend analysis for KPJ Healthcare Berhad. For current ratio, KPJ Healthcare has been on a positive trend since 2021, bouncing back from 0.77 to 1.24. This ratio gives the ability of the company to be able to pay its short-term liability from its short-term asset. A ratio less than 1.0 might be a call for liquidity constraint whereby current liabilities exceeded the current asset. The good uptrend in 2023 and 2024 indicate the company positive goods working capital management might through positive asset structure and reduction of the short-term obligations. A current ratio which exceeds its boundary at 1.0 as attained in the last 2 years is pointer to a financially stable company. Next, quick ratio. The recovery was also pronounced in the quick ratio that leave out inventory. It's bottomed out at zero point 0.5 in the year 2021 and grew to 1.02 by 2024. This trend indicates better immediate liquidity against the company to have more liquid asset such as the receivable and cash to be a better position to meet the current obligation. A ratio of more than 1.0 in 2024 means the KPJ Healthcare is currently in a favorable state relative to its short-term liquidity, and this reassure both creditor and the investor. All right. Next, trend analysis for active ratio. For inventory turnover, KPJ has maintained an exceptionally high inventory turnover, especially in 2021 when it peaked at 31.88, although the ratio has slightly declined in subsequent year, remaining around 28.3 by 2024. But it still indicates efficient inventory management. High turnover suggests that the inventory is being replenished frequently, which have a sign of strong sales or effective supply chains practice. The consistency over the time shows operational efficiency important in the healthcare industry. Next, for receivable turnover. Receivable turnover ratio performance recorded improving during 2021, where it stood at 8.19 but deteriorated slightly in 2022. Seems to stabilize at around 7.1 in 2024. The higher the value, the better, since it means the receivable are collected faster, thus better for the cash flow, despite the limited fall from 2021 peak, which might indicate longer term for credit or delay payment. The relative stable performance above 7 indicate the relatively efficient management of credit. The horizontal trend from 2022 to 2024 can suggest that the company is at operational steady state when the processing the customer payment. That's all. Thank you.
Hello, hi ladies and gentlemen. Good afternoon. Um, so today I will briefly walk you through the trend analysis of KPJ Healthcare from 2020 to 2024, focusing on two key areas, which is leverage ratio and the profitability ratio. So let's start with the leverage ratio, which tell us how the company manage its debt and financial risk. As you can see at the slide, the interest coverage ratio has been improving steadily from 1.69 in 2021 until 3.89 in 2024. This means the company is now earning enough profit to comfortably cover its payment interest. For the formula, a higher ratio mean a stronger financial health. Also, we can move to the debt to equity ratio. Uh, we can see from 2021 in 1.06 to 2.33 in 2024, which means that the company is relying on more on debt to finance its growth. I believe that while this can help expand faster, it also comes with higher financial risk if not carefully managed. Let's move to profitability ratio, which measure how well the company is turning its resources into profit. As you can see on the ROA, which is return on asset, uh, ROA for the KPJ healthcare is improved a lot from 1.03% in 2021 to 4.83% in 2024. This means KPJ is using its assets more efficiently to generate income. As for your knowledge, a higher ROA is a good sign for shareholder and reflects strong operational management. Okay, we move to the gross profit margin. As we can see, profit margin also increased significantly from 33.75 in 2021 to 44.75 in 2024. This means the company is keeping more profit from each ringgit of sales. As for your knowledge, this shows good cost control and pricing power, and possibly a shift towards more profitable services. To sum it up, I think that KPJ is becoming more profitable year by year, and also managing interest costs well and getting better returns from its asset. While debt levels are going up, the company appears to be using that debt to grow effectively. This combination is improving profitability and control financial management, suggests KPJ Healthcare is on a solid growth path.
Assalamualaikum, my name is Muhammad Hanif Iskandar bin Muhammad Sufyan, and I will be presenting the cross-sectional analysis focusing on liquidity and activity ratio for the year 2024, comparing KPJ Healthcare and IHH Healthcare. First, let's look at the liquidity ratio, which helps us understand the short-term financial health of the company. The current ratio for KPJ is 1.24, while for IHH it only 0.72. This indicates that KPJ has more current asset available to cover its short-term liability compared to IHH, meaning KPJ is in a better short-term financial position. Similarly, the quick ratio for KPJ stands at 1.02, which is also higher than IHH, 0.57. The quick ratio excludes inventory, so this shows KPJ is more capable of paying off its immediate obligation without relying on selling inventory. Next, I will explain the activity ratio, which shows how efficiently a company manages its assets. For inventory turnover, KPJ significantly outperformed IHS with a ratio of 28.32 compared to IHH 9.21. This means KPJ sell and replace its inventory much faster, reflecting better inventory management. However, when it comes to receivable turnover, IHH has a slightly advantage with a ratio of 8.83, while KPJ has 7.10. This indicates that IHH collects its payment from customers a bit more quickly than KPJ. In conclusion, KPJ showed stronger performance in terms of liquidity and inventory efficiency, while IHH leads slightly in collecting receivable. This ratio gives us insight into the operational strength of both companies. Thank you.
My name is Nurul Najha binti Naharuddin. My student ID metric is 2024674942. Next, we go to the next slide for cross-section analysis graph leverage ratio between KPJ and IHH. As we can see, KPJ interest coverage ratio of 1.30 is much higher than IHH 0.36, showing KPJ has a better ability to cover its interest expenses. KPJ debt to equity ratio stands at 3.69, which is lower than IHH 5.77, implying KPJ relies less on debt financing and maintains a more conservative capital structure. Next, we go to the graph profitability ratio between KPJ and IHH. KPJ return on asset ROE is 4.83%, slightly less than IHH 4.97, indicating both companies have similar efficiency generating profits from their asset. However, IHH gross profit margin is significantly higher at 72.03% compared to KPJ 44.75%, reflecting IHH superior profitability from sale revenue. That is from cross-section analysis and also graph profitability ratio between KPJ and IHH.
Hello everyone. Hello everyone. Now I will explain our recommendation for both IHH Healthcare and KPJ Healthcare based on the analysis that we did earlier. Okay, for the first IHH Healthcare, we focus on solving their liquidity problem. For the first method, I would recommend that they need to use invoice reminder. We recommend that IHH use invoicing reminder to improve how fast they collect payment from customer. This will help improve cash flow and profitability. Based on a study by Lambert and Farming in 2009, companies that actively collect their receivables this way see better cash performance. And also, for next, for IHH, we would suggest that IHH need to explore short-term financing option, such as short-term loans or credit facilities. This can help them cover liquidity gaps without increasing their long-term debt or affecting their current low leverage. For KPJ Healthcare, our recommendation aims to address high leverage and improve cash flow. First, for debt structuring, we suggest KPJ consider refinancing high interest loan or renegotiating longer term debt. This can lower interest expenses and reduce financial pressure. We also recommend that KPJ need to improve their process to manage inventory, especially medical stock. They can do this by implementing the just-in-time system, which means only ordering stock when needed. This will avoid overstocking and frees up cash that can be used to reduce debt. Uh, for the conclusion, both companies should focus on improving cash flow. IHH by improving collection and short-term financing, and KPJ by reducing debt and managing inventory better. So that's all for my presentation. Thank you.
Next, we go to the conclusion for KPJ Healthcare and IHH Healthcare. KPJ Healthcare has been significant improvement since 2020. It now settles bills effortlessly, shown by its current ratio increase from 0.87 to 1.24. They generate gross margin improved profits since their gross margins rose from 37% to 45%, and handles supplies exceptionally well. Nonetheless, it remains significantly leveraged as its debts exceed 1.3 times equity, which may pose risk if interest rates increase as profit decline. In conclusion, it's healthier now but needs to lower debt for lasting security. Next, we go to the for the IHH Healthcare. IHH is a lucrative company with robust operations and excellent services with roughly 70% margins, yet it faces a significant cash flow issue due to its aggressive expansion plans, which is to increase 4,000 beds across its worldwide service. Nambia and Cameroon 2024 its capacity to cover short-term expenses decreased significantly from 2020 to 2024, where current ratio declined from 1.31 to 0.72. Despite having minimal debt and generating decent profits, it must quickly address this cash flow issue, or it may face difficulties in operating efficiently.